So for me personally, because the long volatility trade is so difficult to manage, it's really hard to get that timing right? Contrarians typically lose. They think that volatility is going to spike, but markets can stay calm for a long period of time, even when you think that next spike is imminent. So it's a really difficult trade to time. And therefore, we only go long volatility maybe 2.6% of trading days, give or take. But when we do, that's when we have to know which underlying security is the best one to take advantage of that. So I actually get a super common question all the time referring to that. People ask it in different versions, but essentially, why don't we use VXX for long volatility positions instead of VXZ? It seems VXX would make a lot more money in a market crash. So where this is going to come up for us personally, this is our total portfolio, but this green strategy, tactical volatility, and the red strategy, strategic tail risk, they both have the ability to rotate out of aggressive positions and into long volatility when we need to. So tactical volatility, it can actually rotate into the VXZ. And we actually got one on March 11th recently. It only lasted a day. Like I said, it's not very common, but we use that VXZ when we get them. And then strategic tail risk, we can go into the VIXM, materially the same thing as the VXZ. And again, we got one of these as well recently. So they do come up, but the main reason that we go to long volatility is not for regular market periods. We are essentially just trying to capitalize on major crashes. Of course, at some point, we're going to revisit this. Valuations right now are very high in the market, and it's been a pretty long bull market run. COVID doesn't really count. I mean, it was a V bottom. It bounced within a month. Government spent a fortune to make sure that's going to happen. But that bazooka of easing the economy might not be available next time. So we are going to get a market crash at some point. Now, in last week's episode, again, I showed that there is an opportunity there to make a lot of money if and when it does. This is just a backtest of tactical volatility, but you can see the opportunity there. It would be pretty amazing to get that plus-minus gap when everybody else is struggling and you're actually there making money and ready to jump into the market again when it recovers. Now, as far as ETFs go, there's two right now that we're comparing. The first one would be the VXX. This is the longest running volatility ETF, launched in January 2009. Now, this one uses the front 2 months of the VIX futures. The VXZ, and for this video, just think VIXM, it is materially the same thing, right? VXZ and VIXM, it's just ETF and ETN, but they're essentially the same thing. These ones are also 1 times long volatility, but in this case, these ones trade the 4th to the 7th month VIX futures. Now, if you're familiar with the VIX futures term structure, you can go on VIXCentral.com and you can look at the current one anytime, but essentially the VIX futures go out in time from the shortest month to the last month. Now, we can place those ETFs on here. The VXX, the 1 times long, using the front 2 month VIX futures is down here. The VXZ and the VIXM are using those midterm futures out here. Now, the vast majority of the time, the slope of these curves down here, M1, M2, is going to be steeper than over here. It tends to be flatter out further in time. And that does mean that these products here, the VXZ and the VIXM, they do move a little bit slower than the VXX does. If we go back to the performance here, you can see that the VXX has bled down on average 48% a year, whereas the VXZ, long-term buy and hold, it's down about 15%. So you could argue that it is a watered-down product, which is why I do get the question, well, why don't you just use VXX? Use the full power ETF and make more money. Well, I can show you with actual results. This is what it would look like in our tactical volatility strategy. Remember, we use the VXZ, that would be the green line, but this is what it would look like if you use the VXX. And yes, no doubt, because the VXX moves more, there is an opportunity to make more money. You can see the VXX would have made about 348%, where the VXZ is about 289. The problem comes in, there are definitely going to be times when you're wrong. There will be times when you get a signal to move into long volatility, for example, and the market doesn't crash. You get that signal right around the time the market is ready to bounce. If we look at our recent market action here, this is the SPY. Just recently, I got my first long volatility signal about here, which is great. The market's down, it's definitely ugly, it's time to get in there and try to make a profit. And if the market does continue down 20%, 30%, or if you get it timed right once every 10 years or so, it is going to go down about 50%, and we're going to make a lot of money when that happens. But that buy the dip environment does exist, and that could be right around the time when people are ready to come in and start buying again. So what tends to happen is you get these little choppy periods where you get a signal, but it doesn't all out crash. You get a signal, but it doesn't all out crash. And those little periods can eat away at your money. You can actually give a lot of your profits back on the other side. That's the problem with using something that moves so quickly. Yes, the VXX can make more money. This is true. But the VXZ and the VIXM are far less punishing when you get it wrong, which, just frankly speaking, we do get it wrong quite often. Not wrong, we get the signal to move into those positions, but it doesn't always all out crash. We go here about 2.6% of trading days. We're in gold about 33, and then we're in aggressive positions during the rest. But the point is, just going by the numbers, look at the drawdown for VXX. Yes, it made more, but a 42% drawdown. VXE made a little less at 289. Not that much different, to be honest, but a drawdown of only 22%, very manageable. And that's what I'm essentially trying to do. I'm only really trying to use these positions when we get it right. And I don't want to get my face ripped off every time I get it wrong. So while it's definitely true that there is probability of making higher profit if you use the faster moving products, and of course, there are even faster ones. There's UVXY, there's UVIX if you're really crazy, but it's the same concept. We're not focusing on the times we get it right. That's kind of the easy part. We're focusing on what happens when you get it wrong. That's what risk management is all about. And the VXZ, the VIXM, again, materially the same product, they are just far easier to manage during all of those other times when you get the whipsaw. The dreaded whipsaw, right? Volatility trading is not as easy as it appears. You don't just enter the position and then money falls from the sky. The timing is everything. And of course, because the market does have a tendency to go down and then bottom, when it bottoms, you can actually lose a pretty decent amount of money with that VXX. The VXZ, VIXM, far less. So that's our choice. We use those ones. I think it's far better. And honestly, like I showed, the profit is actually pretty close. So we're really just looking for those major market crashes. Next time the market collapses, I will be there with the VXZ and I will hopefully make a bunch of money.